Hello everyone, this is a market recap. We have a lot to talk about this week. This is Ahmed Saleh, and we will talk about last week recap, what do we expect for next week, and then we'll have a specific topic on the Chinese stock. All right, so let's talk about last week. We closed September and the average of the close was about 2%. Russell 2000 was almost flat. Okay. On Monday, I mentioned in the last video we had Iran attack over the weekend, so Monday we were expecting it to be like a volatile day, also because it was the last day of September. So we expected to have a little bit of profit taking. And then we had the news about the US port strikes. So this all news came on from Monday through Thursday, and the market reacted negatively to this tension, almost minus 1%, and the Russell is lagging as usual with minus 2%. Yet Friday came, we had two good news. We had the job report and we have the port strike news that it was over, and Friday came as one of the best days. So we closed about an average 1%, and it was led by the Russell with 1.5%. So we ended up October week 1 as almost flat. All right, so let's talk about why the job report was a good report. First of all, the unemployment came down. It was 4.1% versus expectation of 4.2%, and versus last month of 4.2%, and last two months ago of 4.3%. Also, the payroll came higher. The expectation was 150,000. It came about 250,000, and it was above last month of 150,000. So all this news came as positive news to the market. Now, there was some questions about like, yes, but it means the Fed will reduce the rates of the cut. Yes, that's true. But what's more important, the economy or the Fed rates cut? Normally, the economy will win because it's very hard to fix an economy if it goes bad. So when the economy comes good, as we have in this case, it will overshadow any delay in the rate cuts. Okay, so let's see now what happened to the rate cuts. So this is from the Fed Watch. You can just Google Fed Watch and you will see this. It's done by the company called CME. And 1 week ago, we had a 50% chance of 50 basis point cut and 25% chance of 25 basis cut. All right. What is the current situation after the good job report? We have zero chance of 50 basis point cut. Zero. Nobody is expecting that we are cutting rate aggressively. And now there is a 100% chance that we are going to cut the rate by 25 basis points, or what we call 0.25%. There is also some now started to appear. It was zero before that. There is very small percentage that we are going to keep the current rate, but it's very small. All right. So unanimous, 100% chance of having 0.25% rate cut. Of course, this can change in the coming days, but so far this is the case. All right. Okay, let's move on to see what is next. So on average, we see like on the last 10 years, we had October closing at 2.1% gain. It is like the fourth month of gain over the year. So it's a good, it should be a good month. But let's look at September. September was minus 2.2, and we closed actually, as we said now, 4%, 2% higher. So there is a 4% gap between the history and what we closed actually in September. And this was because the Fed cut rates on the 17th of September or 18th of September. So this 4% gap, could it happen again? Yes, it can. So instead of the 2%, we could close higher by another 4% to close at 6%. But call it an average like 2 to 6% or an average of 4% October for gain for the month of October. So this is my expectation for October. Okay. What is even strengthened this expectation is this chart which I shared in one of the previous videos, which says when the Fed cut rates and there is no recession, we call it no landing, as what happened previously in these years, we have 4% gain in the first month, and we cut about 18th of the Fed cut the rate on 18th of September, so we like by 18th of October we should be around 4%. Today we are 2%, so the gain versus the start of the Fed cut it's about 2.3%. Okay, so we still have some room to go still further. And of course, we have mentioned before there is this 3 months, 6 months, 9 months, 12 months. It's all positive and it's very good percentages from 8 to 13% over the coming period. So we recommended that you be 100% in and you be in the market. And so far, this is working well. All right. There is 100% chance in every time this happened. This was the return on the 3 and 6 month, and it's 86 very high on the 9 months and 100% chance on the 12 months. Okay, so it's very high probability. That's why we recommend it to be in the stock market. Of course, this time we have the presidential election, but it should be also adding a very good news to the stock market, because no matter who comes, it will be good for the stock market because they put the economy as #1 on the agenda. Normally Trump, because he's a businessman, he's better for the stock market, and we have seen this last time he was elected. All right, good. So for the risk and opportunities for next week, we have on the risks the Middle East war threat. Still, there are some talks that Israel is going to retaliate, and Biden didn't even prevented them from, or he didn't say that they will not attack the oil. So he has a very controversial statement last week saying that they didn't rule out attacking oil, and that's why oil is going up. And maybe Iran retaliate, and then if things worsen, this can be a risk for the market. We also have an inflation report on Wednesday, and the expectation is 2.5. So anything above 2.5 means again the rate the Fed will not cut the rate that fast. On the opportunities, I've just shared with you now that the market performance is very good when the Fed cut rates. If we get a good inflation report, it's going to be 2.5%. Equal or above 2.5% is a good news as well for the market. And we have seen that in the last 10 years, October was a very positive month, about 2%, without even taking the consideration of the rates cut. On the elections, this can be both risk and opportunities. So I didn't include it here, but let's see how the voting will reveal in the coming few weeks. Okay. About Chinese stocks, last time we talked about 2 ETFs, the KWIB for the internet and the FXI for the large cap, the Chinese. And we talked about several stocks, the Chinese stocks that are traded in the US stock market. And by the way, some of them are traded also in Hong Kong, so you can see the differences in the price. Normally, if Hong Kong increases, then US will increase. So you can see also the difference in the prices in these two markets. So the week one, when China announced the simulation, there was a huge momentum upward. Some stock went up by 36-40% even, and the lowest one in the table is 19%. A huge gain. This is considered a huge gain in 1 week. Okay. Now, in week two, instead of having correction, they continued the momentum upward because the simulation package is very, very good. And they didn't notice anything about Middle East war. The simulation package was much stronger than anything else. Okay, so most of the companies has gained last week as well, except of 2 companies. and the gain was even right. It's a good gain. Like 11%, 5 companies has 12, 12, 11, and 11. These are very good return on investment in 1 week. Okay, 4 companies here. All right. So what I always say in China, you are at the right moment, at the right time, so be in. And you protect yourself with 2 things. The first one is the stop loss. The second one is the position. You can go in with a small position, call it 5 to 10% of your portfolio. And then when you get confident, you make some profit, you can increase your position accordingly. All right. If we had a correction, then you go up. Why I'm saying this, if we look at the history of KWIP, and this is the internet focused ETFs, you will see that we came down from like almost 100 to like 25 on average. And then on the last 2 weeks, we went with a huge momentum upward. You can see here the volume is going up as well. So this is giving us the assurance this is going to continue. And we broke several resistance along the way. We broke here a small one that was in May 24, and here a small one in July 23, an even stronger one in January 23, and here as well in July 22. So we broke several resistance along the way, and now we are like very near to a resistance that was there from January until March 2022. And it was on April as well, 2020. So this is a very important resistance point. With such momentum, most probably it will be broken. We'll see that next week. And the potential is at least to go to 50, which is like from 40 to 50, it's like 25% upward. So we still have a 25% chance to go upward until we hit this resistance here. And if this was broken, we can go up until 80, 70, or 80. So there is still a huge momentum upward, and that's why I'm saying don't let this chance go run away from you. Okay, don't let it run away from you. You are at the right time, and since you are seeing this video, then you have no excuse. You need to react. Okay, and as I mentioned, protect yourself with the 2 things: the stop loss and the position size. Okay, you can, if you are a high risk, you can go into stocks. The ones that I mentioned in the previous slide. And if you are a medium risk, you can go into the ETFs. Okay, so that's all for this week. I wish you a very profitable trade and good luck. Thank you.